Hello everyone. In this video, I will talk about the profitability measures. I will introduce a technique called DuPont analysis, and then I will introduce market measures. So market ratios. So first, the profitability measure is called profit margin equals to net income divided by sales. It measures for every dollar of sales, what's the profit of or net income, so as a percentage of sales, right? So a 20% profit margin means the firm has a net income of $0.2 for each dollar of total revenue earned. And the revenue is on the balance sheet, the top of the balance sheet, top of the income statement. The net income is on the bottom of the income statement. Then we found out that the profit margin for this firm is 10.665%. It means that for $1 sales, 10.665% is net income. The second profitability measure is called returns in assets. Returns on assets equals to total income divided by total assets. It's an indicator how profitable a firm is relative to its total assets. It measures use each dollar of assets, how much net income can be generated. Again, the net income is from income statement. Total assets is from the balance sheet. And the return on assets is 10.41%, which means each dollar of the firm's assets can generate 10 cents of net income. The third profitability measure is called return on equity, equals to total income divided by total equity. It measures the corporation's profitability by review how much profit a firm can generate with the money shareholders have invested. For each dollar the shareholder has invested, how much net income the firm can generate. The net income again is from income statement, and the shareholder total equity, which is the common stock of shareholder, is on the balance sheet right-hand side. So we found out that return on equity equals to 25.17%, which means for each dollar invested by the shareholders, the firm will generate 25% a quarter as income. Here I will introduce this DuPont analysis. We will break down the return on equity. From the definition, we know that return on equity equals to total income divided by total equity. And we multiply this by 1 because total assets divided by total assets equals to 1. One number divided by itself equals to 1. Then we can rearrange this formula. It becomes net income divided by total assets times total assets divided by equity. So what is net income divided by total assets? That is ROA, return on assets. The total assets divided by total equity, that is equity multiplier. So if we know return on assets and equity multiplier, we multiply those two numbers, we can get a return on equity. We can further decompose return on assets. Return on assets equals to total income divided by total assets. We can multiply 1, which is sales over sales. This equals to 1. And multiply equity multiplier, we just keep it as itself. And we rearrange it. So it equals to net income divided by sales. And times sales divided by total assets. Net income divided by sales. That's profit margin. The sales divided by total assets. That is total assets turnover. So ROE, return on equity, can further decompose as profit margin times total assets turnover times equity multiplier. Profit margin is for each dollar of sales, how much what's the percentage of what's the percentage of sales is net income. It measures operating efficiency. If you have relatively lower cost, higher operating efficiency, you will have higher net income for each dollar of sales. Then you have higher profit margin. Total assets turnover measures assets usage efficiency. And the equity multiplier measures leverage. So the return on equity is determined by 3 factors. The first factor is how efficient the firm operates. The second factor is how efficient the firm uses assets. And the third factor is leverage. So the profit margin for this firm is 10.66, total assets turnover 0.976, equity multiplier 2.42. So we multiply those 3 numbers, it equals to 25.17, it equals to return on equity. The equation holds. The DuPont analysis actually can be used to compare 2 firms. If those 2 firms has exactly same return on equity or similar return on equity, we should decompose its return on equity and compare the return on equity. What's the source of return on equity? It is because the firm has relatively higher operating efficiency or higher assets usage efficiency, or just because the firm has higher leverage. The last category of ratios is called market value measures. The first one is PE ratio. It's price per share divided by earnings per share. It measures how much investors are willing to pay per dollar of current earnings. Higher PEs are often taken to mean that the firm has significant prospects for future growth. It means like for each dollar of the earnings, what's the price the shareholders are willing to pay? As we know, the stock price for this firm is $61.625, and the earnings per share is here, it's 2.17 per share. So we found out that the PE ratio is 28.399. The next market value measure is called the market to book ratio. It equals to stock price per share divided by book value per share. Book value per share equals to total equity divided how many shares we have. Again, book value per share is an accounting number. It only reflects historical cost. The market to book ratio compares the market value of the firm's investment to its cost. A value less than 1 could mean that the firm has not been successfully overall in creating value for its shareholders. So the shareholders invest $1, the price they get is less than $1, which means their investment is unsuccessful. The higher the market to book ratio, the higher value created by the firm to its shareholders. So the book value of equity is the equity on the balance sheet, and the number of shares outstanding is given. So the market to book value equals to the stock price divided by the total equity divided by the number of shares outstanding. So it's 7.497, which means if the shareholder invests $1 at the beginning when the firm starts IPO, for example, and the shareholder gets $7.497 at this time point. It's relatively a successful investment. We have some practice related to ratios. First, goods and industrial sales has a sales of this amount, total equity, profit margin, debt equity ratio. Ask you what's the return on assets. Return on assets equals to net income divided by total assets. This is a definition. We can times the sales on sales divided by sales. We can multiply 1 on this equation, it doesn't change the equation value, and we can rearrange it. Then net income divided by sales, that is profit margin, times sales divided by total assets. And the sales divided by total assets equal times the total equity divided by total equity itself. It will not change the value of this formula. So it equals to profit margin times sales divided by total equity times total equity divided by total assets. So if we rewrite this, the last term, the third term as total equity, we divide by total equity on the numerator and so we divide by the numerator and the denominator by total equity. So equals to total assets divided by total equity. So this will equal total equity divided by itself equals to 1. Total assets divided by total equity equals to, those are equity multiplier. So this formula simplified as profit margin times sales divided by total equity times 1 divided by equity multiplier. Remember, equity multiplier equals to debt equity ratio plus 1. So at this point, all those numbers are known. So profit margin 5.1%. We have sales, we have total equity, and we have debt equity ratio. Then we find out the return on assets is 5.05%. The second practice, health centers has a total equity, this amount sales, and the profit margin was a return on equity. Return on equity we can decompose as total income divided by sales and times sales divided by equity. And net income divided by sales, that's profit margin. Sales divided by equity, we have known the number. So we have sales and we have equity, and then we found the return on equity is 7.07%. Third practice, computer geeks has sales of this amount, profit margin, total assets turnover, and equity multiplier. What's the return on equity? And the return on equity as the DuPont analysis shows, it equals to profit margin times total assets turnover times equity multiplier. So we have profit margin, we have total assets turnover, we have equity multiplier. We can find out the return on equity is 21.55%. Tesla Farms has a return on equity 11.25%. That equity ratio, total assets turnover, what's the return on assets? Remember, according to the DuPont analysis, return on equity equals to return on assets times equity multiplier, which means return on assets equals to return on equity divided by equity multiplier. And the equity multiplier equals to that equity ratio plus 1. So then we can find out return on assets is 5.56%. That's chapter 12, and that's all lectures of our semester. And let me know if you have any question, and thank you for watching.